In on yesterday's Market Vitals. The major indices fell after tariff uncertainty resurfaced. Renewed AI jitters also rattled investors. Software companies were hit especially hard after a viral post from Citrini Research reignited concerns about AI's impact on the economy. Meanwhile, Bitcoin continued to slide and gold and silver both rose. Okay, what else is happening? For a fleeting moment, it looked like the courts had put an end to Trump's tariffs. In a 6-3 ruling on Friday, the Supreme Court decided that Trump can't use emergency powers to impose sweeping tariffs. Stocks and Treasury yields rose on the news. Trump then called the decision, quote, ridiculous and extraordinarily anti-American, and then he moved to Plan B. Within hours of the ruling, he announced a blanket 10% tariff on all imports, and then he said he'd bump it up to 15% on Saturday. This time, he's leaning on Section 122 of the Trade Act of 1974, which gives the president authority to restrict imports for up to 150 days. Stocks gave back their gains on Monday as investors digested the whiplash. So many important questions remain. What exactly has changed here? What will happen with tariff refunds? Will consumers and small businesses get any relief? Lots of questions. Here to help us answer some of these, we have a panel of experts today. We've got Peter Harrell, visiting scholar at the Institute of International Economic Law at Georgetown Law School, and also Ryan Peterson, CEO of Flexport. Peter, Ryan, thank you very much for joining us on Prof G Markets. Peter, we will start with you. A lot has happened over the past 3 days. Give us your initial reactions to the Supreme Court's ruling and also Trump's reaction to the ruling.
Yeah, so we got the Supreme Court decision on Friday. I don't think the Supreme Court decision really came as a surprise for those of us who had listened to the Supreme Court hearing back in November. It had seemed like a majority of the justices were skeptical of Trump using this 1970s era emergency powers law for his tariffs. So not really a surprise there. You could also tell the administration wasn't really surprised because while Trump obviously denounced the Supreme Court with his characteristic bravado, the administration was also quite ready to go with their backup plans. As you alluded to, within hours of the Supreme Court ruling, Trump had signed a proclamation using this other statute, also from the 1970s, to impose a 10% tariff. He said on Saturday that he would increase that to 15%, although as of Monday afternoon, he's not done so. So I do think we have to see if he in fact increases it to 15%. It probably will, but we haven't actually seen that yet. That action, what's called 122 action, will keep this either 10 or 15% tariff in place through late July. He can't use that statute for more than 150 days. And so the other thing we're seeing is the administration begin to spin the wheels on some still other tariff laws that could keep tariffs in place once the 122 action expires in late July.
So you mentioned that he puts the 10% tariff in place. That's happened. Then he says we're going to go to 15%, but that hasn't quite happened. Maybe it will have happened by the time this airs. Ryan, I was looking at your X account. You actually predicted that he would bump it up to 15% before he said he was going to do that. You said that he's got it at 10%. And then he said, I predict that he's going to move it up to 15%. You also made another prediction that we'll get to. Why did you say that? And do you think it will still happen?
15% is the maximum of what he can do. And so you figure he has it in the back pocket. He left himself a little cushion to add some more later. And I wasn't expecting him to pull the trigger as fast as he did. I thought he'd wait a week until... In my prediction, I said, Canada is going to do something to piss him off, and then he's going to do it. But it turned out America beat Canada in the hockey game. I thought that would be the funniest thing that could happen is if Canada beat us, and then he said, all right, here's some more tariffs for you. But didn't need to do that.
The other prediction you said, you wrote, quote, 150 days from now, the tariffs will be paused for 15 minutes and then immediately reinstated for another 150 days. And this goes back to what Peter was mentioning here, that there is this 150-day time frame, and that's what's legal. You say he's just going to cancel and renew. Take us through that.
I'd like to hear Peter's take on that and other people too. I'm not a lawyer, and there's nothing explicitly in the law that says it says you can't extend it beyond 150 without Congress's approval. But if you left it expired, you let it expire and then put a new one in. Surely it would get challenged. It might lose the case, but he could do it. I don't know. What do you think, Peter?
Yeah, so I think, I mean, there's one question about how do I think the courts are going to interpret the law, which is not really the question of what Trump will do, right? Because Trump's going to do what Trump's going to do. I actually feel pretty confident that if Trump tries this strategy of 150 days, expires for 15 minutes, another 150 days, the courts will throw that out. Now, it might take them a couple of months to throw that out. So Trump might, get another couple of months before the courts throw it out. But I think the courts would throw that out.
It's kind of an interesting thing here of even with IEPA, even if you knew it was going to get thrown out and you knew you'd lose the Supreme Court case on Friday, he still got quite a lot of leverage from putting it in. I mean, he got all kinds of countries to come and make a trade deal with him. Most of those countries are not going to undo the duties that they dropped their tariff rates or lowered other barriers, and they're probably not going to just turn around right now and drop it. It's sort of interesting to think of what are the rewards that Trump gets even from effectively what he did was break the law. It's interesting to think about.
Well, what do you think this does mean for other countries, Peter, in terms of, I mean, they came up with these sort of semi-deals, they're more kind of spoken word agreements, and then everyone puts their tariffs in place. If you're a foreign government, if you're, say, Brazil or you're China or the UK or whatever, do you react to this news? Do you decide, okay, I guess we're taking the tariffs down, or do you react to the 10% or the 15%? What does this mean if you're a foreign government?
Well, the first thing I would say, and I said this last year, that in 2025, the biggest true winners of Trump's trade war are the trade lawyers. I think it is going to be true in 2026 as well, that the trade lawyers will be the, one true class of winners. And so I think what you're seeing right now is the foreign governments are talking to a bunch of very expensive trade lawyers to try to understand what's going on and what they should do to game this out. Look, I think the question in some sense is in Trump's court in the following way. I think that if you are Europe or you are Japan or you are one of these other countries that has a trade deal, if it looks like Trump is going to keep your tariff rate at the rate that was agreed to or lower, right? If you'd agreed to a 15% rate, if it's going to be a 15% rate or lower, I think you keep honoring the deal, right? Because you don't want to piss Trump off. He might sanction you. He might, who knows what he's going to do, right? So I think you keep honoring it.
He has these other levers. He can put Section 232, Section 301. He has other things he can go do.
Totally. So I think you stick to it. Now, if what Trump does is use this as an opportunity to somehow hike rates. Like if you were at a deal, if you're the UK and you have a 10%, rate in your deal, and he's now hiking that to 15, I think that becomes a little more complicated a question for you. But if Trump plans to keep the rates the same, I think most countries will basically continue along.
Ryan, you kind of have the most direct line of communication with the businesses that are dealing with this because you're operating the logistics as they trade goods around the world. What are businesses and companies doing about this, if anything? In the same way that maybe there's a question for foreign governments, do we react? Are you finding that companies are reacting to this news?
Well, it's a bit of a popping of champagne that's happening right now. People are expecting to get refunds. I expect to get refunds. A lot of the trade attorneys and advisory folks are a little bit hesitant to just say something. I don't know. Lawyers don't like making...
Yeah, you're going to get a refund. It might take you a couple of months, but you're going to get a refund here, Ryan.
Right, he's on my side. That's why I think it's so obvious. You just read the motion that DOJ filed in the appellate court, and it's just like, we will give refunds if we lose this case. You're like, okay, great. Now you're gonna give refunds. Trump says they're going to fight it. It's going to get litigated. Surely that's true, but they got to lose the case. It seems like a slam dunk.
How does the refund process actually work?
Right. So there's a fair amount of uncertainty there. What we do know is under the customs regs, you basically have a maximum of 494 days after a customs entry is filed to do what's called file a protest. And that's the maximum. It could actually be less. So you want to get these things filed sooner than that. So you're going to have to go back and file protests on all the entries that you did that had IEPA tariffs. And so actually the first IEPA tariffs didn't come out on Liberation Day. They came out on February the 4th of last year with fentanyl tariffs on China, Mexico, Canada. I think February 4th is the first. I forget the exact timing of those three different things. But so your clock is kind of like maximum of 494, but honestly, you're pushing it close to the edge, and you don't want to get past that date. If you get past that date, it's too late to file a protest, and at that point, you actually have to file a lawsuit to undo the IEEPA tariffs, and lawsuits are very expensive. Protests are pretty cheap. Flexport and others can just file a protest for you. That's what we're doing with our customers right now is now that this is now a thing, that they've been overturned, we've been ruled illegal, we're going through with all of our customer base and filing protests for all of their IEEPA entries going back to February 4th of last year. And then we've also created a process on our website at tariffs.flexport.com. At the top, you see refund. Currently, it says refund calculator because that's what it said as of Friday. I'm trying to get the team to update it just to refund, claim your refund or something. But that's what that is we're bringing people in. First of all, calculating the dollar amount of how much is potentially owed, I think likely owed, very high probability, and then getting you enrolled in a program where we'll go file those protests for you. What we don't know yet is filing a protest enough? If I file a protest and you acknowledge it as CBP, do you now send me a check, or is there some other mechanism? And we won't know that until it gets litigated and they lose, I think. And then Customs will provide some clarity for what comes next. But for sure, we know you got to go get your protests in if you've got any entries. And if you're only to take one thing away, if you're a business out there, is follow your protests. And if you want an easy way to do it, call me.
It sounds like you both strongly agree that refunds are coming.
I was just saying, think about it this way. There's nothing magic about tariffs that make them different from any other tax, right? If President AOC had declared we're all paying 70% income taxes now, and the court said, no, there's no 70% income tax, of course, we'd all be saying, we get our money back, right? It just would be obvious to everybody. And the U.S. government actually, it processes on the different agency, but on the tax, on the income tax, they do 120 million refunds a year, right? It's not like the government doesn't do tax refunds. It's not like the tariffs are some magical thing the government can just keep when they're illegal. They're like any other tax. So I do take the point, and I very much agree with Ryan, the government can make this hard, right? They could try to not issue refunds just as companies are filing protests. They could try to require everybody to come in to sue. Like, they could make this administratively hard, but at the end of the day, whether the government goes the easy way or the hard way, the money's going to be ordered to be turned back over.
Yes.
And by the way, the government prepared itself. So Flexport has gotten over $700 million of the customs refunds for our customers in the last 5 years. So Peter's point is like a very normal thing. It's very possible, this is a normal thing. You file a protest, you get your money back. The government has been sending those as paper checks from the Treasury Department for the last 5 years. And they get lost in the mail all the freaking time, and they get cashed by scammers. It's a nightmare. Well, about 2 months ago, maybe in anticipation of Friday's ruling, they updated their process to say all refunds will now be done electronically through ACH. And if you want to refund, it was like auspicious. We're all looking at this going, why are they suddenly getting their house in order and how they're going to process refunds in a more automated fashion? So
it does bring up this question of who's really in charge here. And I think this is why I, at least, and I'm sure many observers, feel a little bit skeptical about the refund idea, because this is really the policy that Trump has hung his hat on. It was all about tariffs. And so the idea that the Supreme Court is going to come in now and say, actually, you don't have the power, we're striking it down, we're not going to let it happen, this whole thing that you built your entire administration and campaign on is going to be a failure, it's not going to work, we're going to send all that money that you bragged about for a long time, that you were very excited about, we're just going to send that all back. And so I, as an observer, look at that and I think there is no way that this guy is going to let that happen. I don't know how, but I just get this feeling that he's not going to let it happen.
I think it's a valid point, and we should clarify some things here. So the Supreme Court struck down the IEEPA tariffs, which was one form of tariff. Did not strike down those other two forms that he's done, are Section 301 and Section 232, and now the new one, Section 122, are other forms, and those have not been challenged. In fact, those have been challenged in the past and held up. And so reasonable confidence there, but they're different. The IEEPA gave this like sweeping blanket power, and that he was really stretching, and the Supreme Court ruled he stretched too far. You can't use it the way he used it, but these other ones are more targeted. Section 301, you have to do it on a sector basis, and it requires an investigation by the USTR. or Commerce Department, I forgot, one of those two, or maybe both, I forgot how it works.
USTR for that one.
USTR for Section 301. And it requires an investigation that they got to go launch. And there's 12 of those currently underway, investigations. So expect more to come out in that regard. 232 is done on national security grounds, which is 232 is where you get your steel and aluminum tariffs. But also, this one has to lose in court, I think, Peter. But they also used it to impose tariffs on furniture and saying that that's a national security concern. Steel and aluminum you get, you're like, all right, we need to make tanks or something. But the furniture feels like
we need our office chairs.
You need desk chairs in the Pentagon, right? You know,
furniture. You know, the gold-plated.
There is another big question here, Peter. I mean, it sounds like the consensus is the refunds will happen based on the IEPA, and maybe Trump will just say, okay, you can have that money back, but we're going to figure out more tariffs going forward. But the other big question here, importers, companies, businesses, they're going to get their money back. But there is someone else who paid a lot of the tariffs here, and that is the consumer, on which as much as 60% of these tariff costs were passed on through. The numbers vary, but that is a number that has been cited. Are consumers going to get their money back, Peter?
I hate to say this, but the answer to that is probably not. And here's where you really have to distinguish between the law of the tariffs and the economics of the tariffs, right? Under the law of the tariff is paid by the importer of record, which, might be Home Depot directly. It might be a wholesaler. It might be a small business, but it's the, entity that actually imported the good from abroad paying the tariff. And that is who will, under the law, be able to get the tariff back, whether Trump makes it easy for them or whether they have to sue through the courts for the next, 1 to 2 years. That it'll be the importer record who get the money back. Now, in some cases, there might be a contractual arrangement between like a wholesaler and one of its customers where the wholesaler is contractually agreed if I get my tariff back, I, have to pass on some of that to the, to the retailer. But even if that is the case, when I went to Walmart and bought something that was, 10% more expensive, I have no right to get that money back from Walmart. So this is clearly going to be a political issue. I think we're already seeing people in Congress talk about it. I am sympathetic to the kind of moral argument here and to the sort of political issue that is coming down the pipe. But in sort of a legal sense, there's no way for me, having actually paid in an economic sense, but not in a legal sense, many of these tariffs to get my share of them back.
And I agree with that. And I would add to what you say by, consumers are probably getting nothing. They have not only they have no legal, they have no leverage. But whereas the wholesale thing that Peter points out is quite interesting to dig into, which is I've already talked to a couple, like one importer I talked to yesterday. He's getting it, if all things go well here, he's going to get a $12 million refund, and he owns his business. I mean, this guy is off the charts.
New vacation homes coming. I mean,
I told him this guy. I sent him a link to a civilian Blackhawk he can probably buy for let's buy a helicopter, dude. And no, don't do that. Most lottery winners go bankrupt. Don't be that guy. But his concern, which I hadn't really thought about before, is like he knows Target and Walmart are going to call him, and they're going to like, "Hey, where's my cut, man? You guys, you raised prices on us." So I think that wholesale retailer relationship is going to be fraught, and there's going to be some fights there. And those guys have leverage. You're like, okay, don't give us any money, then you don't get to sell in Walmart next year. So that's interesting. The other really nuance here is it goes to the importer of record, which is, the one that Peter missed on that is actually in the United States, you can have a foreign company as the importer of record.
Yeah, it's true.
And that's the one that's really going to anger Trump. Because about what we've seen in our data is, not in our data, but in public records that we've analyzed, is that the number of foreign importers of record has been usually about 9% of U.S. trade is done where a foreign company serves as the importer, at least on ocean container trade, which is the easiest place to access public records. 9%. That between April of last year and when we ran this analysis, I think it was like in November, it had gone from 9% to 20%. And that's because there's a huge amount of tariff fraud where what was happening is foreign companies would switch and they would import the goods. They would underdeclare the duties and not pay them properly by just saying, hey, these things are worth $100,000. No, they're not. They're worth 10. And then you just reduce your duty rate by 90%. And first off, those are the guys going to get the checks, not the It's like Trump's going to be wiring money offshore directly in this thing. It's going to really drive him crazy. And the importer that used to import the goods, so like, let's say I'm a brand, I'm buying goods in the U.S. or buying goods from overseas. Traditionally, I was the importer of record. In order to avoid duties, this is what was really going rampant. I mean, 11% of all trade flipped to this. They would say, hey, the factory's going to import the goods for me. I'm not involved in the import transaction. I don't worry about that. They pretend like it's not their problem and they don't know anything about what's happening. Well, they're getting no refund at all because the money's just going to their factory. So that's like an interesting nuance here that there was a lot of fraud happening and been watching closely. And I don't feel bad for them at all because they were cheating, so they shouldn't get a refund.
Right, exactly. But it sounds like they probably will. I mean, what we've done here is if we've kind of deteriorated our relationships with a lot of other nations and made things more expensive for consumers, and now we're going to take the money that was passed on to the consumers and we're going to send it back to a lot of foreign nations. I mean, to me, it's a total disaster, but we could probably go on for hours with this conversation. We should start to wrap it up here. Peter, just before we let you go, any predictions for how this will play out moving forward? Who will be the winners? Who will be the losers? How will it all shake out?
So I actually think the hardest thing for Trump about losing his IEEPA tariffs is not going to be the sort of 15% tariff rate on Japan or the 20% tariff rate on Vietnam. I think he's ultimately going to be able to recreate those tariffs under other authorities. What he's going to find frustrating is that IEEPA was really the only law he could wake up on Tuesday and say, you know what, I want Greenland, and they're going to be 20% tariffs on Europe on Friday if I don't have Greenland. Like, none of these other laws let him just kind of pull out the tariff Sharpie and sign an executive order and impose tariffs. He actually has to do fact-finding. As Ryan was saying, you got to have either the U.S. Trade Representative or the Commerce Department do fact-finding, spend at least a couple of months to do investigations. You got to show there's like a trade problem or a national security problem with the good we're importing or the country we're importing it from. So I think he'll be able to recreate this kind of 10, 15% tariff rate he likes, but he is really going to feel the bite of not being able to just wave his tariff Sharpie around and threaten tariffs whenever he's mad at somebody.
Ryan, we'll give you the final word. Predictions on how this will all shake out.
Well, I thought Peter's earlier point of the trade attorneys are the ones who are really going to benefit here. It's just a lot of complexity. The one good thing about IEEPA was like it was kind of simple to understand. There was a rate per, you see the rate on the country, and now it's these sector-based things come with all kinds of nuance that's really hard to unpack. Section 232, steel and aluminum, as a really good example, where you have to know the dollar value of the steel and aluminum within the overall value of the product. It's like you have to break that out, and now calculating the duty is much harder. And doing this on the line item level for every product you enter, and you're going to get more and more complexity because, yeah, it's not just a blanket thing on the country. It's like, the sector investigation of this HS, this category. And often those Commerce Department investigations are done like on a blanket basis, saying on furniture. Well, furniture is not just a thing that it's lots of different HS codes, and duty rates are dialed down into the HS code, the harmonized schedule code. So you now have to translate executive orders or other forms of regulation into the customs actual day-to-day life of a customs broker, and it becomes quite hard. So you need tools. I'll final plug. I get to finish tariffs.flexport.com. We've built some nice free tools for you to help manage this annoying environment.
All right, Ryan Peterson, Peter Harrell, really appreciate your time. We'll have to do this. The law literally says, this is only legal if it is in response to, quote, an unusual and extraordinary threat to America. And there was no unusual or extraordinary threat here. I mean, Trump said the threat was the trade deficit that we have with many other countries. But as people have said over and over, and as we've said, a trade deficit is completely normal. That's not a threat. And indeed, that is what the court ruled. As we've discussed before, this all goes back to who has the power to do what. And when it comes to issues of taxes, or as James Madison called it, the pockets of the people, that power lies with Congress, not the president. And tariffs are essentially a tax. So tariffs are now illegal. The obvious question is Now what? Will the tariffs just disappear? Will there be tariff refunds? What will happen to all of these trade deals, or as we prefer to call them, concepts of plans of trade deals? These are the trillion-dollar questions on which thousands of businesses and workers depend. And the answer is a pretty unsatisfying one, and that is we don't really know. We don't really know what will happen to those trade deals. We don't really know what will happen to the refunds, and we don't really know what will happen to the tariffs themselves. Most things are up in the air, which is probably why the markets are reacting the way they are, and that is they're reacting very ambivalently. Now, we can make some educated guesses based on what we do know. And I think the first thing that you should count on at this point is that the tariffs are still on. Trump immediately responded with those 10% tariffs and then 15% tariffs, which are legal under that U.S. Trade Act of 1974. The only caveat is they only last 150 days, at which point they must be approved by Congress. So what we can expect is that the tariffs will remain on the table. Trump and his legal team will be fighting tooth and nail then to figure out how to get them extended in some way, either through Congress or through some other trade law. So my expectation, and I think it's Peter and Ryan's expectation too, that tariffs will remain in one form or another for the foreseeable future. Now, what does this mean for our deals with other nations? Well, as you know, I don't think we ever even reached a deal with any other nations. My definition of a deal is a written contract signed and ratified into law. We didn't really get any of that. All we got was spoken frameworks that were really heavy on the PR and really light on the details. So in that sense, I'm not sure much has changed here. We still have no deals. We still have no certainty. And yes, we have still degraded our relationship with most of our allies around the world. That all remains the same. The biggest question is the tariff refund. Because if those $175 billion in tariff revenues were illegal, which they are, then businesses are now entitled to those refunds. Now, I'm not sure how it will work. As Justice Kavanaugh wrote, the refund process is likely to be, quote, a mess. But here's what I can tell you. If those refunds do happen, then the people who actually paid them, that is the American consumer, they will not get their money back. As we've discussed before, it was Americans that paid the cost of tariffs through higher prices. And according to the Yale Budget Lab, of the costs, as much as 63% was passed on to consumers, which is why your grocery bill exploded last year. But unlike importers that have direct receipts of their tariff payments, you, on the other hand, don't. Which means even though you paid the cost of tariffs, you will not be getting a refund. And so what this really boils down to is, once again, a direct wealth transfer from regular Americans to large corporations. Trump has, once again, I'm sorry to say it, screwed over the consumer. And we can hash out the finer details as much as we like. But big picture, that is what happened here. As I've said before, Trump's tariffs will go down as America's Brexit. Minimal upside, maximal downside, and an economic outcome that made regular Americans, for the most part, poorer. That will be the legacy of tariffs. And we are now watching that legacy unfold right before our very eyes. Thanks for listening to Prof G Markets from Prof G Media. If you liked what you heard, subscribe to our YouTube channel and
opposed to the person with the asset.
Right.
Now, when interest rates are 1%, it's pretty hard because money's almost free. When interest rates are higher, like they are today, much more interesting because money's expensive. And so the person with the money has more negotiating leverage, perhaps, than they certainly do in a lower interest rate environment.
Yeah, we often talk about you want to look for forced sellers, people who they need to sell for any of the various reasons that you just highlight there. That's when you're going to get a great price. Is there any advice that you would give to young people who want to get into investing right now? Possibly someone who maybe wants to start their own fund. I feel like it's not as much of a thing anymore. Young people going out and starting their own funds, probably because of competition. The people who are starting companies these days, they're selling tech companies. They're not selling investment firms or asset management firms. So what would be your advice to a young person starting out in their career, wants to get into investing, and also maybe they want to start their own investment firm?
So my younger brother, who's now in the US, came over from Australia. He grew up in advertising, okay? He was in radio. He's like a smart ass, and he writes jingles for advertising. And he got to the US, wanted to change careers. And so he teamed up with a guy in Austin, Texas, two young guys. Like my brother is 40, his partner is 30, something like that. And they saw an opportunity to go and buy pool cleaning businesses, literally the folks who go and scoop the leaves out of your pool. And the reason that was interesting is that you can buy those businesses for low cash flow multiples, and there's a huge network effect. Like if you own a lot of those businesses, the trip time between one customer to the next is so much shorter than if you're a one-man band sort of, going all across town from one pool to the other.
Yeah.
And so what they did is they literally went around Austin to golf clubs and other places in Houston and family offices and whatnot. So again, my brother's got zero business experience at all. His business partner had been a CFO or something like that in a private equity startup portfolio company. So had a little bit of business experience, but a little bit to our earlier conversation about just jumping in. They went around and they had a business plan and they started to line up businesses to buy. Now, these pool businesses are pretty small, $5 million here, $2 million there, $10 million there. But they lined up these acquisitions and they went around and said to just high net worth individuals, hey, this is what we're doing. Would you invest with us? And they managed to pull together $30 million of high net worth money, and they went and bought $30 million worth of pool cleaning businesses. They then marked that up to $100 million, and they went and raised another round at $100 million. Then they went and did the same thing for HVAC services businesses. So the person who comes and fixes your air conditioning or fixes your heater, they did the same thing for that. And now they're going out and raising a private equity fund. So I've seen it in action. And I think that if I had to summarize that, it's identifying a little business niche that you think is interesting to go and buy and lining up some deals, and then going and lining up some money. People love to see deals. If people see deals, they tend to be willing to turn up with money. So there's a real life example of a person who really from a standing start is now sitting on a couple $100 million of capital under management, and I think is well positioned to go and start an investment firm from that.
Final question from me. Who are your role models? Is there anyone in business or in life who you really look up to and who you've tried to sort of emulate?
We mentioned it earlier. I think Buffett is far and away the best investor I've ever seen. I can't recommend highly enough for folks just to go and read his letters. Go and buy a book. There's a great book out there that literally just has all his annual letters. It's so interesting to read. I forget his first annual letter might have been in the late 60s. I've read every one of those letters from the late 60s through to today. It's the best business investing learning you will ever get. So in that sense, he's probably the investor that I've tried to learn the most from. Now, I think he's so special you could never emulate him, but I've tried to learn the most from him. I learned a lot from Steve at Blackstone. I learned a lot from Tony James at Blackstone. I had a boss at Macquarie, Murray Bleach, who was the person who just threw me into the deep end. I learned a lot from him. Nicholas Moore, who ran Macquarie and really established infrastructure as an asset class. I mean, he trained a whole generation, several generations of infrastructure investors and entrepreneurs. So I've been very fortunate to be at really two of the greatest, I think, financial institutions on the planet.
when I was a first-year analyst right out of UCLA at Morgan Stanley. I don't know if you know this, but I'm not like really good with details. And before there was GPS, there was maps, and I lived in LA, and my other analyst, Don Larson, we had to go to Stanford for a recruiting trip. So we're bombing to the airport. I take a right turn on La Cienega instead of a left turn, and finally Don catches up with me and says, "You're going the wrong way." Turn around, get to the airport, and we see the plane pull away. And then there's one every 30 or 60 minutes. San Francisco, we're at Stanford lecturing, talking about how great Morgan Stanley fixed income was, which was a total lie. So we went up there and started lying to people.
It's the job.
And then a woman comes in and says, "Is Donald Larson here?" And they said, "Yeah." And Don went out and he came back in and he was all upset. His father had had a heart attack. And because the plane we missed went down. And it was, you're too young to remember this, but it changed aviation history because a disgruntled employee got on the plane with a gun, and employees up until that point didn't have to go through metal detectors, pilots and crew. And he shot the pilot, and the plane crashed, and everyone on board died.
Oh, my God.
And because I turned to right, we missed the plane instead of a left.
Oh, my God.
I thought to myself, does anyone I know that I'm even up here? And it was no, so I didn't make any calls. And of course, my friend, this Dennis, my roommate from the fraternity, was expecting me and called my mom. And my mom called my assistant, and my assistant looked it up and said, "Yeah, he was on that flight." And so I called my mom, and my mom had friends over because they thought I had gone down on this plane, and she thought she was hallucinating. Not a Hallmark story here. Not a Hallmark story here. But anyways, Ed, people think I'm inconsiderate because I'm late all the time and I get lost a lot. I don't mind missing stuff and being a little bit late. It's worked out for me. It's worked out for me.
You're focused on the important stuff. That's what matters. But yeah, that is crazy. I'm just imagining you driving a car right now, which I can't picture. And I wonder, are you a good driver? Because I know you don't drive anymore, really.
I'm a great driver because I grew up in LA. And I started driving literally at the age of 15 and a half. I got my learner's permit. And then back at California dreaming culture in California was, I'm not exaggerating, I got my driver's license on my 16th birthday. And it just freaks me out that my son right now is technically, 9 months away from driving, which makes no sense. But yeah, when you're in LA, you just drive everywhere all the time. So it wasn't that I was especially deft at driving, but you just get very well practiced.
When's the last time you drove?
That's really interesting. It's probably been a couple of years. I don't drive, but I can drive stick. I can drive a big rig.
Wow.
I love cars. When you grow up in California, you love cars. I just don't. I hate shoelaces, passwords, keys, and cars because they all demand things from me. Also, most of my relationships are now starting to ask for something in return, which is really bumming me out. That's not why we're here. The key term is service, specifically acts of service from you to me, and I pay for everything. That's the deal. Talk to me about cars, Ed. Do you own a car?
I don't own a car. My girlfriend does, though. And so I drive around with her car, and it really is sort of a game changer.
What kind of car does she have?
Subaru Outback.
So she's a lesbian.
Yeah, exactly.
Sorry, Ed. So should we tell him?
I had the same reaction in my head.
And let me get it. She doesn't want to have kids, but you're going to get a German Shepherd puppy. Do you want my car history?
Yes.
My first car was the best gift I have ever received, hands down. Best material item that has meant more to me than anything. And I have a lot of nice material items. When I was 15, when you lived in California, if you didn't have a car, you had no social life. There was no subway. There was no Uber. We had the RTD, which was just awful. And so if you wanted to have any social life, you had to have a car. And my friend Adam got a Fiat Spider, and then he bought an Austin Healey Mark 7. He was like fucking James Bond. He was this good-looking guy in a leather coat. I didn't have the money for a car, and my mom borrowed money to buy an Acura, and she gave me her lime green Opel Manta. I remember the day she came home. We used to practice driving it. She'd come home and go into the underground garage in our apartment complex and honk the horn, and I'd run down, and she'd teach me how to drive stick. And on my 16th birthday, she came home in this new, like, bad Acura, and she came up to me and put her hands on my shoulders and said, "You're a handsome man who owns his own car now." And she gave me the keys to her Opel Mana.
That's nice.
Oh, I'm going to cry. Isn't that nice?
Yeah.
Anyways, I had that. Then I had a Renault car. Then I had a Rabbit. Speaking of closeted heterosexuals, convertible Rabbit. My girlfriend in college dated a guy with a convertible Rabbit. I'm like, okay, should we tell her? Anyways, and then out of business school, hit it pretty early, got the Lexus GS 300, which was the bad Lexus that never had a market, but it was a Lexus, and I was super excited. Then I had 3 BMW 7 Series in a row, including Jason Stavers, who used to work with us here at Prof G, used to house sit for me. And he calls and says, I forget we're on vacation. We used to go to Hawaii because we lived on the West Coast. Says, well, I got in a terrible auto accident. I ran the car into the side of, like, I think it was Grace or St. Anne's Church. Like, he swerved out of the way, piled into the...
I did not know. Jason totaled your BMW.
Yeah, Jason Stavers totaled my first 7 Series. He doesn't bring that up much anymore. You know, we do employee reviews. You're about to get yours tomorrow. By the way, we're asking you for money back. You're not getting a bonus. But I remember I couldn't wait to do his review because I had it as the first bullet point in his review. Totaled boss's car. Anyway, so he goes, I had this terrible accident, your car stopped. I'm like, just stop right there. I'm like, the important question is the following. How was the car? Ed, are we done with banter?
Let's call it there. We've got a big interview to get into here. All right, let's get into our conversation with Tom Lee, co-founder, managing partner, and head of research at Fundstrat Global Advisors. Tom, thank you for joining us.
Great to see you, and Merry Christmas.
All right, let's bust right into it. You've been vocal that investors are still underestimating how strong 2026 can be. Why are you so bullish on 26?
I think the economy and stocks have been suppressed for the past few years. Part of it is, of course, that we've seen 6 what I call extinction events take place in markets, everything from COVID to the bullwhip supply chain effect as the economy restarted, to the fastest inflation cycle in history, and then followed by the fastest Fed hikes in history. And then we've, of course, had a very controversial administration which put tariffs in place in April of this year that caused a miniature bear market. And then we've even had the U.S. bombing Iran's nuclear facilities. I think all of these collectively have made investors very nervous about what I call investing in full risk, because these are what 6 black swans that happened in 4 years. And I think on top of that, we've had a Fed has not really given a green light about monetary easing, and I think the Fed's reluctance has actually suppressed business, quote, animal spirits, because the ISM has been below 50 for more than 3 years now. So I think that's all been a business cycle that has been pretty good, but not one that has been really expansionary, and I think that starts to happen next year.
It feels as if the market has become so concentrated or dependent or circling around a small number of stocks that to be bullish on 26 sort of mandates that tell me if you think this is true, indicates that you're bullish on the Magnificent 10 and AI stocks. Is that necessarily true? And are you bullish on the Magnificent 10?
Yeah, I mean, I think 2026 is going to look a lot like this year, meaning we are probably going to have many months where the market is actually down year to date. You know, I mean, this year we were down double digits at one point before the market recovered. I think that plays out next year. But for the reason I previously stated, I think that we end up a bullish outcome despite all the skepticism. And it does require large cap tech and AI stocks to still produce earnings growth and not have a lot of PE reduction so that you still get positive return. But I think the rest of the stock market, so the other 490 or so, can actually perform well, because if the Fed is cutting and interest rates are coming down and the business cycle is sort of really starting, that's good for other stocks.
As you say, we've seen a lot of these black swan events, things that you would think would freak the markets out and make people worried. And yet, I look at what has happened in the markets, and my view of it is it's not necessarily that it's suppressing sentiment. To me, it almost looks like the market is deciding to shrug everything off. So when you describe how, perhaps these black swan events have made investors perhaps have lower risk appetite. To me, I'm almost kind of taking the other side of that in my head. I'm like, it seems as if these things happen, these things that are concerning. One example would be what we're seeing with these AI circular deals. And it seems to me that the market is kind of swatting it away, shrugging it off, and the market continues to climb. And that's what we've seen this year, and we saw it the previous year, and we saw it the year before that. We continue to have this bull market, despite what many would say are really concerning events. So how would you think about that? How would you respond to my concerns there?
You're almost kind of mirroring what we're observing, but just with a different take. I mean, our take is markets climb a wall of worry. Historically, when there's a lot of skepticism, stocks can rise. In fact, markets actually peak on good news. They don't peak when people are bearish. Markets peak when everyone's bullish, and it no longer responds to good news, just like markets bottom on bad news. And I think many people are skeptical, but stocks have risen. It doesn't really mean markets are shrugging off the concerns. That's one way to interpret it. My other interpretation is, there is a wall of skepticism. And I mean, maybe that's just it is like maybe we're just talking about the same sides, just of the same thing. And but like if someone asked me, is it worrisome? I was a technology analyst in the 90s, so I covered wireless stocks starting in 93, and I witnessed the bubble that was created, a decade in the making, really 2 decades in the making. And by 99, not only was there no skepticism, there was excessive entitlement. Investors were expecting stocks to do explosively, and a 20% upside wasn't satisfactory, and valuations were already elevated and expanding. So I'd say that if I was trying to compare this to the bubble of the 90s, and wireless was a central cast character in that internet infrastructure build, I don't really see the echoes of that today.
I think it's so interesting what you say there about, we're looking at the same things and we're drawing slightly different conclusions about what that means for markets. And we had a similar conversation with actually, you were the chief equity strategist at JP Morgan. We spoke with their head of investment strategy, Michael Semblest, and we were talking about a lot of these issues. And where he ultimately landed was he was quite bearish or bearish-ish. And I just want to play you what he said and get your reaction, see what you think.
It would be kind of shocking if you didn't have some kind of profit-taking correction in 2026 at some point on the order of 10 to 15%. It would be, I'd be really surprised not to see that.
So that's his base case, is some sort of correction, 10 to 15%. Looking at your 2026 outlook, you've got S&P price target of 7,700. We're at 6,850. So that would imply, a little over 10% rise next year. So 2 very different views. Where do you land compared to his view? What do you think he might be overlooking, and where do you differ, do you think?
Our outlook actually does call for a drawdown next year. So very similar to this year, of probably closer to 20%. So I think we are going to have another miniature bear market next year, but then we're going to recover. I mean, let's take 2025. Let's say that at the end of 2024, and actually we did talk about, the idea of a drawdown in 2025, but let's say that someone plays the clip. So let's say it's Michael Semblest, but let's just pretend he's saying at the end of 2024, and he says the market will be down 10 to 15%. That doesn't rule out where we are by the end of 2025, because in fact, we did have a drawdown. And I think I'm not again saying I actually think Michael and I are pretty aligned in the sense that I think there is going to be a drawdown next year. He says he wouldn't be surprised. But to me, it doesn't mean that's the end of the actual bull market. And in fact, I think stocks fully recover.
So the wall of worry here that we're talking about and that you outline in your outlook, you got several elements in there. You've got, and these are the things that you describe as people are worried about, investors are worried about. So politically divided nation, social unrest, Supreme Court overturns tariffs, new Fed chair. And then you have two ones here that I really agree with. I feel like I'd love to have you dive in on. AI valuations, which I think a lot of people are concerned about. And then also 20% equity returns in the past 3 years, i.e. each year for the past 3 years, the stock market has risen by an average of 20%, which may imply maybe we're running out of steam at some point. Could you just unpack what your concerns are in that wall of worry? And do you think those would be the trigger of such a correction?
Let's start with the one that you just mentioned. The stock market, we're up 16%. So I think if we rally 3 percentage points, we'll be 3 years of 20% gains back to back. And it's actually more common than we realize. In fact, when we look at the last 65 years, it's happened in 20 different, I think it's happened 20 times in different countries, and multiple times in the US. 12 times. It means a lot of good news is priced in. I mean, of course, stocks being up 20% a year, 3 years in a row, it's definitely pricing in a lot of good news. So to me, I do think that we have to consolidate those gains. And that's why I think a drawdown next year makes perfect sense to me. But because there isn't a lot of leverage in the economy, household sector has not really borrowed money. It's been expensive to borrow money. And even margin debt, it's risen, but it hasn't risen parabolically. So it's actually essentially tracked S&P gains. So it's not like people are borrowing faster than the market's been going up, especially if you look at a 5-year CAGR. So I would be in the camp that as long as the economy's holding up, that drawdown is going to be viewed as a buying opportunity. Now, on AI valuations, it makes perfect sense for someone to say a lot of the valuations for AI are probably absurd because this is the nature of a exponential sector, right? If we look at an industry that could grow parabolically for 10 years, all of the future value is in the latter half of those years, right? So and then we're trying to discount that back to today. And so stocks are going to look absurdly expensive. And more importantly, investors make a common mistake, which is that they assume that the existing universe of companies are going to be the central cast characters over the next 10 years, which is not the case. So the reason valuations don't make sense today is that, one, of all the AI stocks, I'd say it's probably safe to say only 10% are going to be good investments. Maybe it's even generous, maybe 5%. And of course, there's going to be a new emergence set of new players. And in fact, the economic model might change. But it doesn't mean it's a bad investment. And we've highlighted this as generational traits in past reports. For instance, like if you look at the internet, if you bought the internet basket in 99, okay? So you bought it near the peak and you held it to today, you actually still outperformed the S&P 500, even though 99% of the stocks went to zero. So it was a bad investment if you tried to pick a winner, but it wasn't so bad if you held it as a basket. So I think AI, it's probably going to be fair to say 90% of the stocks are going to do way worse than people expected. They were too optimistic. But I think as a basket, it's probably going to outperform.
That all makes sense to me. I'm with you. But it seems to be a little bit more nerve-wracking when we realize that a lot of the AI companies are the largest companies in the world. It's the big tech companies. I mean, I think Google is an AI company at this point, or an AI stock, Meta, Nvidia. I mean, these are the largest, most valuable companies in the world. And the market really depends on their performance. So when I think about the idea that many of these companies and the expectations that have been pinned to the AI cycle, the fact that that could affect some of the largest, most valuable companies in the world, where we're seeing the highest concentrations in those small companies, the higher concentration than we've ever seen in history, to me, that makes it scarier, what you just said. So I guess my question is, do those companies, do the big tech companies, the Magnificent Seven, do they count in your analysis of AI valuations being too high and the possibility that perhaps we might lose out, or that the value won't actually show up for many of these companies?
I might even just add to your concern, because there's a lot of CapEx here too. So that these are, a lot of the Mag 7 used to be asset light businesses. The remarkable equity, sort of rent-seeking model of them was that they could create growth with very little spending. I mean, R&D spending was there, but really CapEx was not there. But today, as you know, AI is extremely capital intensive and it's energy intensive. And it's only justifiable if it's replacing real work somewhere else. Then you can justify, because now it's creating assets to replace future OpEx, I'm going to give you a spin about what's happening that is not disagreeing with what you're saying, but it's probably observing a change in the reality, okay? Which is, tech companies are becoming a bigger part of our life. So naturally, they're going to have a larger share of spending. By the way, we wrote about that in 2018, that if you go back to 1930 and you just use simple demography, population tables, whenever the population growth rate grows faster than the prime age workforce, which means you have compounded labor deficit, you've always had a technology cycle. That was 1948 to 67 and 1991 to 99. In both of those periods, the population growth rate was growing fast, which is demand, faster than worker supply. And we entered the third epoch or era of labor shortage, which started in 2018 and it's going to last to 2035. So then technology spend is necessity because you don't have as much labor available, so there's going to be less wage spend.
Yep.
Now, if I substituted the word and called this, instead of the word banks, tech companies, I call them financial institutions, we would not be saying there's a financial institution bubble, because for every unit of GDP growth, there's a unit of financial spend. I mean, it's literally the other part of the ledger. And in fact, the financial industry has all circular spending. I mean, think about this. Real estate is valued as a separate asset, but every company needs real estate just to run a business. So why are we valuing real estate? Like in a GDP sense, real estate should be an interim product, not a final product. So I think tech is becoming so central to the economy, especially because of labor shortage, that when we see tech intensity growing, people are flagging that as a bubble, whereas I'm actually just pointing out it's actually out of economic necessity. But it becomes a bubble if the multiple we're applying to the tech streams don't justify higher valuation. I think tech earnings are probably more valuable than Costco, for instance.
Yeah, agreed.
Or Walmart, right? But Walmart trades at 37 times forward earnings and Costco trades at 50 times. So Nvidia trading at 27. I mean, is there a bubble in Costco and Walmart because Nvidia is at 27 times earnings?
100%. And we've looked at that Costco valuation. It's crazy. I totally agree. But then I go back to something that Aswath Damodaran said when he joined us on the podcast. And he said he can't see value anywhere. He thinks everything is overvalued when he looks at the stock market. So that's the other side. And I as Scott and I have discussed, we're not necessarily in agreement with him on all of that. But that I think becomes a concern. And then to the circular deal making and the capex point, I think the concern, unlike the financial institutions, is like we haven't seen the AI product proven itself yet in terms of its ability to provide the value that we're pricing in, I guess is the problem. We haven't seen that these data centers are even going to be necessary to keep the workforce and the labor market going, as you say, to keep our economy growing at a fast clip. Therefore, it seems that we're making giant predictions with not that much evidence, which, we could call it a bubble, or we can just call it what I said, which is we don't really know what's happening, and yet we're spending tons of money. And so if there becomes a moment where suddenly everyone says, wasn't what we thought it was, then that could be quite damaging to portfolios.
Yeah, 100% agree. Because, by the way, anything that is reliant on future growth, none of us is an expert on the future. I mean, that's right. Like that, there's many roads to the future. One thing I just want to point out, Benjamin Graham's book, The Intelligent Investor, which I did read. I don't know if you remembered his rule of thumb about what a proper PE is.
No, please.
It's 12 times plus 2 times the growth rate. That is in his book. I'm just saying, when someone says they're a value investor and they're saying stocks are expensive, I know they didn't read his book because I read the book.
I love that.
But, as you know, that's because he didn't believe things could grow 10% a year. That's the reality. Like 10% is a lot of growth back then.
Yeah, that was a pre-digital economy.
The second point I would make is when I did wireless in the 90s, okay, now I was in my 20s. I was a senior analyst at the age of 23. So I was really lucky to be very young and actually a senior equity analyst. But when I was covering wireless, the industry only had 34 million cell phones in 1993. And the industry telecom services was dominated by long distance and local telephony, these things called the Bell operating companies. And they made all their money from 2 businesses. The Bells made the biggest profit maker for the telephone companies was the directory business. And number 2 was local business telephony. They made more money selling local exchange service to Chase than they did from any other business. So when wireless was happening in the 90s, as me in my 20s, my imagination was ignited. And, I talked about how, you could do so many more things with cell phones. And we joked about how it would have changed the path of like the Revolutionary War, right? If Paul Revere had a cell phone. But most of the money managers were in their 40s and 50s, and all the experts were in the 40s and 50s. And they mostly thought cell phones was an expensive yuppie toy. They said the economics didn't make sense. You could never fit that much traffic on cellular waves. And all the money was in long distance and local. So the telephone companies and the long distance providers, including MCI, would do everything to protect their existing businesses and use regulatory strengths to make sure cellular never really grew. Now, look back. That was, of course, the wrong bet. And remember, cellular companies had to spend $50 per pop to build out a cellular system. So if you took any city of 10 million people, you had to spend $50 per person just to build a basic system. It was enormously expensive, and cell phone penetration was 6%. You had to make a bet that you would have a lot of penetration. I think that I'm seeing people make the same arguments against AI. And I think one of the things we have to say is, which lens are you using? If you're using it through the lens of a 40-year-old, really wealthy person, no new technology looks interesting to you because you're more interested in protecting your wealth and incumbency. But young people are the ones who change the world. look at Chase Institute. Credit card spending growth only comes from people under age 50. And what are young people doing with AI? I mean, my daughter is, one of my daughters is in college, my youngest. They have adapted to OpenAI and ChatGPT in a way that I can't even fathom. And so those people represent the future vintage of AI adoption. Just like cellular adoption in the 90s, it was 70% of 20-year-olds had a cell phone, and it was like 5% of 60-year-olds. So, of course, all my clients...
You can't avoid the catastrophizing around the destruction in the labor force from AI. Do you still believe we're going to be in a cycle of labor shortage even with AI?
I vacillate because there's times where when I read a book like The Coming Wave, I panic and I realize wow, we need to re-educate society. But one thing that gives me hope is that we did at Fundstrat study another technological wave that wiped out at least 20% of the labor force in the 20th century, which was frozen foods. So what many people don't realize is that when Charles Birdseye created Flash Frozen, which, by the way, was a venture backed by Goldman Sachs. It was a VC-backed company.
I love this.
And by the way, his name is Birdseye because he was an ornithologist. He actually was studying birds. But he found that the Inuit tribe in Alaska had kept their fish super fresh, and it's because they were putting it in a frozen saltwater solution that flash froze the fish. If we look at the labor tables from the 20s, 40% of the U.S. labor force was employed on farms. It was literally, most of the economy was people working on farms, and most of the service sector that was defined back then were household servants, people working for someone else. Food was over 25% of the wallet prior to frozen foods being widely, mass market, because most food spoiled on the way to the supply chain. And so grocery aisles were mostly fresh. And what was frozen back then had freezer burn. It was terrible. So flash frozen allowed suddenly the cost of food to drop dramatically because you had less spoilage. And the number of people working on a farm today is down to 2% of the U.S. workforce. So flash frozen was really the key innovation that brought down the cost of food from 20% of the wallet to 5 or 6% today, and reducing farming labor from more than, I think it was 40% at the peak, down to 2%. An economist in 1920, okay, let's just pretend on CNBC in 1920, there is none, but let's say there was a CNBC in 1920, and these economists were saying, frozen food, if it comes along and it's going to wipe out 95% of all farmers, this is going to wipe out the U.S. economy. The U.S. economy can't survive frozen food. And instead, it freed up time, right? And it allowed people to be repurposed, and it created a completely new labor force. So Scott, to your point, I think that there is an adverse outcome, but then when I look at past episodes of huge labor disruption, it's actually had positive outcomes.
Every technology thus far, it's followed the cycle you're talking about, some short-term destruction of labor, and then profits and innovation get reinvested, and we reinvent ourselves. But we're about the same age, Tom. I want to walk down memory lane. In the 90s, I think you were a telco analyst with Kidder and then Solomon. Is that right?
Yeah, that's right.
And I was raising money for internet companies, the internet company that started e-commerce companies in the 90s. And I can't help, but this smells a lot like Teen Spirit. I feel like I've been to this movie, and I have this certain muscle memory, and it might be wrong, but I'm curious if you think my timeline trues up with where you think we are, and that is the economists perfectly called the dot bomb. They said how it would happen, how it would unwind. They were exactly right. But they called it at 97. And the NASDAQ doubled between 97 and 99. And what you said also that really struck was that the market seems to be climbing a wall of worry. And that is, in 97 and 98, we were just very anxious. These things are overvalued. There's no way we can sustain this. And the markets kept going up. And then in 99, we had this zeitgeist where all the short sellers, all the hedge funds, I mean, Julian Robinson just like threw in the towel and gave up and said, I can't predict this market. And then there were all these articles. I remember one specifically in the Wall Street Journal saying, maybe we have moved to a new economic model that the internet has ushered in, and we should be thinking about things differently. And then wham, the market crashed. So if I were to look back and try and equate this to the 90s and the internet, the internet timeline, it feels like we're more like 97 and 98, a ton of catastrophizing that might indicate a surge up. My sense is when prices are, PE multiples are crazy, which I would argue they are right now, they go insane before they crash. Does this timeline, is that even useful to think about, this economic history? And does that timeline sort of where 97, 98, not 99, true up with what you're thinking?
It does, Scott. We both have experience of 35 years or more in markets and in technology. And we have to keep in mind that the median tenure of a portfolio manager today managing a fund is 9 years. So they've experienced the markets really only since 2015, being generous. So to them, the 90s is only a legend that their bosses talked about or things that they heard, and it's become second and third hand stories. Now, when I was a wireless analyst, there was so much meat to the stories in the 90s, in the 97 period, like real things happening, TDMA, adoption, the quality of the customers were good. There was real spending taking place. It wasn't startups paying for everything, But by the late 90s, the customer quality had already essentially, you exhausted the post-pay world. You had to suddenly go into a prepaid model. And, technology, what we called it bleeding edge. There was innovation coming, but there wasn't apps and services to support it, like, picture messaging and, these were still years away. So I'd say that there is going to be a moment where, like, we've all gotten so accustomed to stocks going up that we insist that that's the new regime. Like, that's what you're talking about in like 2000, right? That's when everyone capitulated. But that's not what I encounter today. When we talk to our institutional investor clients, this is a market that's frustrating to them because they don't really want to be buying expensive stocks. There's a lot of discipline in place today. And I think that discipline is the reason markets are climbing a wall of worry, because I think there's, as you know, a lot of cash on the sidelines. Sentiment is still really bearish, and a lot of people are claiming that we're at a top. But again, I just, in my experience, people are not bearish at the tops. They're bullish at the tops, and I don't really find that many bullish people.
When people talk about the types of jobs that AI will, quite frankly, destroy, I think they're describing the analysts at Fundstrat. So tell me what is actually happening on the ground at Fundstrat. How are you using AI, and what, if any, impact is it having, or do you think is going to have on your human capital?
Wall Street itself has actually been a victim of technology because, first, many investment firms have been using essentially versions of AI systems for a long time, right? They've been investing in quant systems and models. And the sell-side firms have invested in technology to replace labor constantly. I don't think there's been a year in my career on Wall Street that money wasn't being spent to actually reduce the labor intensity of the job. I mean, I remembered when I was at JP Morgan, in the 90s and the early 2000s, trading occupied a huge percentage of the cash equities business, real estate. It was a couple floors. And then one day went to electronic systems, and like the number of traders went to like, a tenth of a floor. So I think that's the nature of Wall Street, that every job is eventually automated away. And so value capture is shifting around. In the 90s, when I started, equity research was a back office job. It wasn't like, because I went to Wharton undergrad and I graduated, I wanted to get into research. Firms weren't really actively hiring for research. Research was an apprenticeship industry. You had to find a job and find an analyst that would hire you and take you in. Of course, research has become a much more important business today as other parts of Wall Street became commoditized. But, when I graduated in the 90s, traders were the highest paid people. The sales trader, they were like the masters of the universe. And of course, now it's just computer code. So I think you're exactly right. In the future, a mediocre research person is not going to be any better than a mediocre OpenAI or LLM, right? So Wall Street needs to constantly evolve. I know that at our company, we are using AI at so many levels. It's not just research, and we are using it to ingest data, but it's really how we manage our data now, and even how we manage our customer service experience. Because Fundstrat has 11,000 RIA and family offices, plus around 400 hedge fund clients. So but the way we manage them and identify their needs, we are using AI. So I would say I have not found any of the AI models that have been shown to us and that we trial, because everybody wants Fundstrat to adopt one of their models, has not been good at stock picking. We actually run 3 ETFs. Fundstrat Capital has Granny Shots, GRNY, GRNJ, which is a small mid-cap version, and GRNI. But GRNY has a 1 year of history, has outperformed the S&P by 800 basis points this year. And none of the AI systems that have been shown to us have actually outperformed our own process for stock picking.
What would you say makes a great researcher and a great analyst? And then I want to get into crypto. So this is one of my final AI questions. But when you talk about AI is going to replace the analyst, what are the kinds of skills that makes you irreplaceable as an analyst? What kinds of things should white-collar workers, working professionals in general, be trying to work on and be trying to hone in order to not be replaced by AI?
AI is very good at looking at the past. So if you need to build a model, you need to recall data, even say, give me the last 12 times something happened. That is AI. But as you know, to do true training, then you need to have it work in the future. Now, future has not a binomial outcome. It's multiple forward scenarios, and the probabilities are unknown of each future event. Okay. So you're dealing with so much uncertainty that I don't know how a probabilistic way to give you a single point answer would ever work. I mean, to give me an example, someone will say, this is the fair value of a stock, and they say this is the PE and this is the E. And I can never understand that, because I'm always wondering, which E are you using? And you know what I mean? Because price is today, but then which forward metric, and then how do you discount it? How do you explain to AI that you have to look at 10 years of future earnings, but you don't know which future earnings will actually matter the most? And then how do you assign the weights? I mean, that's really what we do at Fundstrat, is we're constantly assessing the probabilities of future events and then deciding. We do have to pick a direction, right? Then we say this is the path we're going to take, but it's a guess. So I think that the best qualities of a researcher, at least in my opinion, are you do need to be unemotional, but you also need to know the difference between conviction and being stubborn. Because stubborn is riding something and believing in something when all the facts have changed. Conviction is basically riding through the volatility, and it's not easy to tell the difference until history has already passed. And I think, the third thing that's really important in markets is to know what's already priced in. I don't know if AI is going to really have a good sense for Like if AI is the only thing managing money in the future, I think a human will beat the market because all the AI systems will be predictable. You know what I mean? And then you can spoof them all. So that like that's really where I think human judgment matters because I'm constantly surveying our clients and I'm in constant touch with them. So I kind of know where the money is and what the bets are and how they react to the Fed. And I don't know how you can program AI unless it is, well, they'll get very good, but they should have had a good year this year and it was on track to until there was a liquidity crisis on October 10th. That was a bigger wipeout in terms of liquidation than any event in history. The most recent one before this would have been 2022 with FTX. And that wipeout pales in comparison to what happened on October 10th. But in 2022, it took 8 weeks before crypto, the smoke cleared, the leverage wipeout was enough in the mirror that crypto prices began to recover. This week is the 8th week since that crisis. And I think crypto prices are beginning to actually recover. That's why I think Bitcoin can double from here by the end of January. Now, many people don't expect it because of the 4-year cycle. And that's going to be the big question. If Bitcoin breaks 125 in January, there is no 4-year cycle.
What did happen on October 10th? Like, everyone knows crypto markets got hit. It seems unclear to people what actually happened. And as you say, it was one of the largest liquidation events that we've seen in the history of crypto. What happened?
I'm going to give you what we've been able to piece together. And I would say that it's like a 90% correct because, there's going to be 10% you don't know if there was something else.
Just to clarify, is the reason we don't know what's happening because of the anonymity of crypto? We don't know who owns which wallets, and so it's harder to track what's actually happening?
Well, it's that, and plus, if when we look at liquidation events, like in the stock market, 90% of what someone will explain is probably correct, but 10%, like 90%, it'd be 90% to correct say that the February to April decline was largely due to the Trump tariffs.
Yes.
But the other 10% would be like, well, stocks were already expensive and they were overdue for a correction. So that's what I mean by 90-10.
So give us your 90%. What do you think happened?
On October 10th, there was 2 things that happened. One was a triggering event, which was Trump announced, a re-escalation of tariffs with China, like a tripling of proposed tariffs. And because markets were closed, historically, crypto is what reflects reaction to a macro event when you're already after market hours. Like if the S&P was open, crypto probably wouldn't have been gut punched as hard. But crypto prices fell. Now, crypto prices falling, system can handle that because, crypto is a hyper volatile by nature. So large swings in prices shouldn't really overload the system. And even volume shouldn't overload the system because crypto trades, there's so much automated trading. However, there was an algorithm in place that actually what I call a glitch happened on a specific exchange, okay? Many people use leverage in crypto. I mean, it attracts leverage trading, but people put up collateral so they can do leverage trading. One of the collaterals is stable coins, okay? And stable coins are pretty safe collateral because, hey, if it's Tether, it trades at $1, it's pretty safe collateral. And so you can borrow a lot against safe collateral. And if it was USDC, Circle, that's also a really stable coin because it's backed by $1. However, there was a popular stable coin called USDA. It was an algorithmic stablecoin, okay?
Okay.
And on one particular exchange, because of the shock of Friday, internal prices, like people bid ask of that stablecoin actually got out of whack. Suddenly, the price went to 65 cents, even though it's supposed to be essentially worth $1. So, but within one exchange, that the quoted price dropped to 65 cents. Well, that meant that all the collateral for every account that used that particular stablecoin to borrow money was now in deficit. Okay, even if it was just $1 that traded at that price, it was already putting every single piece of collateral at risk, into deficit. So then something called ADL was triggered, automatic deleveraging. And so in one exchange, everybody who would use that stablecoin as collateral basically got wiped, their accounts liquidated. Well, what were those accounts long? They were long altcoins and all these different cryptos that suddenly got dumped onto spot exchanges. So then on all these other exchanges, suddenly some altcoins suddenly went down 99% because there was a lot of selling from ADL, but it triggered a domino effect of all these other exchanges triggering other ADLs because spot prices of all these alts dropped. So that to me was a glitch because it was like an illiquid quote that didn't represent a true VWAP triggered an ADL that triggered a cascade of ADLs. And that led to millions of accounts being literally zeroed out. It won't happen again, I'm sure, because in the future, I'm sure they will use a composite set of prices, or if there's a variance between what's quoted internally versus on spot, or if it's a volume-based measure. So that's why I don't think it would happen again, but that's what happened on October 10th.
Okay, we finally got our answer. I've asked this question to many people, and I never get a proper answer. My takeaways from that are that, it seems vulnerable. This asset class that is, supposed to be a hedge in a lot of ways, we are learning in various ways is extremely vulnerable to what seems to be almost nonsensical mechanical glitches, which I guess that is my takeaway.
In 2020, the price of oil went negative, right? I mean, oil is the most liquid commodity in the world, and it traded at a negative price. So these glitches happen in all markets, but it does happen in crypto because it's a gigantic place where people are trying to experiment and create, what they view as free from censorship and interference. But of course, every event's going to bring something new, and you're 100% right. It's terrible that it happened. But again, I remembered oil was negative, and people actually were able to buy negative oil. They were paid to take oil.
I guess I'll wait for a negative stock price.
I'd love the opportunity to get negative stock. Remember bonds? Corporate bonds had a negative yield in Europe. You were actually paid to own, an issuer was paid to issue a bond.
Can you identify any sectors or geographies that you think are dramatically over or undervalued right now?
Undervalued, I think, is small caps, because there is real earnings growth now coming, but there is no money flows. So small caps are a whole group that professional investors can afford to ignore because no one else is buying them. The amount of active money in small caps is at record lows. I think financials are also dramatically undervalued, Scott, because, this is where we could be wrong. But in my view, I think the financial sector is actually becoming a tech sector, that as money is becoming more digital and as AI implementations are heavily, heavily taking place in financial services, it's going to it's creating an advantage for the companies who issue capital. And in companies like JP Morgan, probably, as we just discussed earlier, could really dramatically reduce their dependence on humans, which is their largest expense. So I think financial companies are increasingly going to look like tech companies, and their multiples may become more like tech multiples. So that to me is one group that in the future could have a 30 PE, even though they used to trade at 10 times earnings.
We've been talking with a lot of different people in the markets. We've been talking with renowned professors, investment strategists, economists. We talk with a lot of people. Most of them are somewhat bearish right now. You are one of the only real bulls that we've talked with. I've seen you described online as a perma-bull. That was what Bloomberg called you. What do you think about that label? And how is it that you are bullish right now in a sea of bears? And what do you think that says about who you are?
I was first called a permabull in 2009. And in fact, it was major newspapers that were using it as a mocking term. Here's what's interesting. 16 years later, what was the right call to be?
Oh, the optimists have won.
And yet today, if I had to say what proportion of investors are bullish versus bearish, it's really risen in the last year. In fact, it's kind of close to the 2009 levels. I think people are already betting on the fact that we're in a bear market. And now, many people were convinced of that in 2022 because of the Fed hikes, and they just never changed their views 3 years later. But as you know, what made people a lot more bearish is also because President Trump is a very unpopular president. He's a very divisive figure. I'm a registered independent, so I have never tried to let politics be involved in how I view markets, but I can't help notice that I think that political lens plays into many of our clients' views around markets, that they tend to view. When Biden was president, there were a lot of people who were critical of Biden. I thought the economy, I've cared about the economy. I thought the economy was fine. I think the economy's still doing fine under Trump. So that's kept me, I use that as one level of coding that I think has kept people bearish. But, you know, I think America is, as long as it's a place of innovation, and we are because we're at the center of AI, I think it's pretty bullish. But you guys have raised the key point. I mean, there's a chance that this AI is a disaster for labor markets. And if it is, the U.S. will be the least scathed, but everyone's going to go down.
Tom Lee is the co-founder, managing partner, and head of research at Fundstrat Global Advisors, a leading independent research firm. He has more than 25 years of experience in equity research and has been top-ranked by Institutional Investor every year since 1998. Prior to co-founding Fundstrat, he served as JP Morgan's chief equity strategist from 2007 to 2014. Tom,